Hello viewers and welcome to the channel. My name is Shannon Rivkin. In this week's video I'll be talking about mainstream group holdings in the context of of our event portfolio, which I will show here, which is Rivkin's probably longest strategy that we've had, and probably percentage-wise is most successful as well. And I want to talk about mainstream and why this event strategy has worked out so well for us in the past, and just show the events track record over the last in 2020, which obviously was a very challenging time for the stock market in general, but saw a success rate of well over 80%, I should say. One stock here was a small loss, and this one here was a bigger loss, and I should say, happy to talk about that one just to simply demonstrate the risks and why this needs to be looked at very carefully when considering to buy into these sort of events, which for the most part are takeovers. And to show that certainly in the once in a lifetime pandemic, even the the easiest deals that you think are likely to conclude can go wrong. So, for example, with Pioneer Credit, we bought in this one pre-pandemic, just the beginning of January 2020. It had signed a deal with a private equity group. Anyway, as most of these deals are signed and they are binding between the two parties, it's pretty standard for a lot of these deals to have what's called a material adverse change clause attached, which basically means that between signing a deal and completing a deal, if the business deteriorates significantly enough, we can walk away effectively. And that's exactly what happened here. As the pandemic took hold, the business, at least in the bidders' eyes, deteriorated significantly. There was a fight between those times, which I guess to some degree we made the mistake of thinking that it might be salvaged, arguing that the material adverse change clause hadn't necessarily been triggered, but the simple reality is the environment was so tricky that that no one could be sure of how Pioneer's business was going to unfold, and ultimately allowed the bidder to walk away. But in the absence of that, once things stabilize, you can see how reliable this strategy can be for the most part as well. The environment is brilliant. We've seen, for the most part as well, new bids on the majority of these, which is one of the oldest rules, is the first bid is rarely the last, and it's the core foundation of this strategy. Anyway, mainstream is one that was a liquid, so it's certainly not one that we could buy in significant numbers, but in our separately managed accounts at Rivkin, in our defensive income strategy, as well as some discretionary accounts, we were able to buy this one after it received a bid at this point of $1.20. This was from a company called Vistra, which is a huge company listed in on the New York Stock Exchange. Really small bite for them, mainstream is as well, and really I think rather an entry into a new market rather than anything else, which means I think this has strategic value rather than wanting, I would say, to buy this thing at a good price. And at being able to buy here, we've now seen a new bid here at $2 from SS&C Technologies, another big company listed on the NASDAQ, and so that's been a 60+% return for investors in a very short period of time. And why we were able to identify this opportunity is, again, something that I think you probably need some experience investing in these sort of opportunities to recognize. But so Mainstream signed this deal with Vistra at what was a pretty small premium, only a 12% premium to its previous trading level, and I think because of that, while Mainstream was comfortable accepting the deal and walking away, they also accepted that the premium wasn't big, and they negotiated what is called a go shop clause, which I can't seem to find at the moment in here, but it was a very important feature of this. So what this meant is that while $1.20 was the deal, they were actually allowed to go out and see if they could find a better offer. For the most part, these friendly deals usually do not allow that. They usually also encapsulate exclusivity, and so for the most part, if you're going to see a new bidder emerge in some of these other deals, it needs to be out of left field, whereas in this case, Mainstream were able to go out and shop for a new buyer themselves, and that's exactly what happened. They announced just this week that the conclusion of the go shop period has been reached, and they were able to find a new buyer from SS&C Technologies, which is a company that they have a good relationship with already, as they use a lot of its technology for their own platform, and a logical fit. And again, I think from SS&C's perspective, a strategic move into a new market rather than necessarily them buying at a good price. And I think it's at a 25 times EBITDA multiple, which does seem very high, but clearly they've come out with what they believe to be a knockout price. But again, potentially still more ahead, because as part of the original deal, Vistra has what's called a matching right, which allows them to at least come out with an equivalent offer. And as the first mover, if they do come out with a $2 offer, then Mainstream needs to stick with them. And of course, then the game continues, because their SS&C, which is just bid $2, might decide there's still more cash available if they think the strategic fit is worth it. So, to buy into this one at $1.20 or $1.21, we got in knowing that the downside is basically nil, but with exposure to significant upside if new bidders emerge. That's the core foundation of the strategy and portfolio, and why it's performed so well over many years. But the important thing, of course, is to be comfortable with the conditions attached to any deal, understand how things can go wrong, and while they can go wrong occasionally, the vast majority of them go very well, and it's why the strategy has performed very well over a long period of time. Anyway, thank you very much for tuning in. If you liked the video, click like and subscribe, and I'll be back to you next week with a new video.